Four times in the last 35 years, the financial system has been shaken to its core, and four times the same five assets have come out the other side not just intact, but stronger than before. 1990, the Gulf War. Oil prices spiked 65%. The Dow dropped 20%. Those five assets went up. 2008. The global banking system nearly collapsed. The S&P 500 fell 57% in 17 months. The same five assets, same direction, up. 2020. A pandemic shut down the world economy in 23 days. The fastest market crash in recorded history. Stock market down 30%. The same five assets rose again. And now, in 2026, the fourth window is building. The same five are positioning the same way. What you are looking at is not a coincidence. It is not luck. It is a pattern. And once you understand why these five assets behave the way they do, what they have in common, what makes them structurally different from everything else, you will never look at a financial crisis the same way again. You will stop seeing a crisis as something that happens to you. You will start seeing it as something that happens to people who did not know this. Five assets. The data from each crisis, what Warren Buffett actually owned or said about each one, and a clear picture of how to apply this without being a billionaire or a financial professional. If you stay until the end, you will walk away with a framework that most people never build because they are too busy reacting to headlines to notice the pattern hiding inside them. If understanding how wealth actually holds together during moments of global chaos is something you want more of, subscribe to this channel. New videos every day, in language that actually makes sense. Here is what all five of these assets have in common, and why it matters before we get into each one specifically. During a financial crisis, the thing that is really under attack is not the stock market. It is confidence in paper. Confidence in the idea that a dollar or a bond or a company's future earnings are worth what people said they were worth yesterday. When that confidence cracks, capital moves. It moves from paper promises to things with intrinsic, physical, or irreplaceable value. The five assets that survive crises are the five assets where that movement lands. They are where the money goes when people stop trusting everything else. That is the mechanism. Once you understand it, the pattern makes complete sense. And here is the psychological piece that makes the pattern possible, the part nobody talks about. Every single time one of these crises hits, the majority of investors do the exact wrong thing. They sell. They panic out of the assets that have the most structural protection and into the assets with the least, cash in low-yield accounts, or completely out of the market, watching from the sidelines. And in doing so, they create the very opportunity that the prepared investor captures. The fear-driven selling is what depresses prices on the good assets. The prepared investor buys at the bottom. The panic seller watches the recovery happen to someone else. This pattern has repeated in 1990, 2008, 2020, and every major crisis before them. It will repeat again. If you want proof that the five assets work, you need to look at 1990 first, because it is the oldest and most often overlooked. The Gulf War sent oil prices surging 65% in 3 months. The United States went into a recession. The S&P 500 dropped roughly 20% from peak to trough. Consumer confidence collapsed. And during that period, specific assets not only held their value, but rose. Gold appreciated. Energy companies, the ones that extracted and processed the oil that everyone was panicking about, posted strong earnings precisely because their product was surging in price. Consumer staples companies saw their products bought regardless of economic anxiety because people do not stop buying toothpaste and canned food when war breaks out. The pattern showed itself clearly for the first time in the modern era. Then came 2008, the most severe financial crisis since the Great Depression. The S&P 500 dropped 57% from October 2007 to March 2009, erasing roughly $11 trillion in U.S. household wealth. Major banks, Lehman Brothers, Bear Stearns, Washington Mutual, collapsed or were absorbed in emergency rescues. Unemployment eventually hit 10%. And inside all of that destruction, the 5 assets held. Gold rose approximately 25%. During the same period, the S&P was losing more than half its value. Consumer staples stocks dramatically outperformed the broad market. Energy companies with pricing power stayed resilient. Strategic cash, held in short-term government securities, earned a steady return and, critically, gave its holders the ability to buy assets that were being panic-sold at historic lows. Berkshire Hathaway deployed over $15 billion during that window, only because the cash was ready. In 2020, the fastest stock market collapse in history unfolded in 23 trading days. The S&P dropped 34%. A global pandemic shut down entire economies. Nobody had a playbook for it. And yet, same 5 assets. Gold hit a new all-time high of $2,089 per ounce in August 2020, as central banks globally printed unprecedented quantities of money. Consumer staples companies outperformed the market because food, medicine, and household goods did not stop being purchased. Energy initially crashed as demand evaporated, but recovered sharply by late 2020 and 2021 as the rebound drove fuel consumption back. Cash-heavy investors, including Berkshire, were positioned to act when everyone else was frozen by uncertainty. The pattern held for the 3rd consecutive major crisis. If you are finding value in what we are building here, a real framework, not just financial noise, let me know by writing in the comments, "I own the pattern." That is the shift this video is about, seeing the structure instead of just the headlines. In August 2020, gold reached $2,089 per ounce, the highest price in its recorded history at that point. The S&P 500 had just finished recovering from its 34% crash. Central banks around the world had injected trillions of dollars into their economies in a matter of months. And gold, the asset that Warren Buffett famously said just sits there, had risen more than 28% since the start of that year alone. That number is the starting point for understanding Asset 1, not a theoretical argument about gold's long-term value. The data comes first. In 2020, while the most unprecedented economic disruption of the modern era unfolded, gold did exactly what it has always done in moments of monetary panic. It went up. Go back to 2008. The S&P 500 finished that year down 37%. Gold finished the year essentially flat, and then rose over 25% between October 2008, the peak of the crisis, and the end of 2009. While banks were collapsing and mortgage-backed securities were becoming worthless, gold quietly held its value and then appreciated. The reason is structural. Gold has no counterparty risk, which is a technical way of saying that gold does not depend on anyone else's promise to be worth what it is worth. A bond depends on the issuer's ability to pay. A stock depends on the company's future earnings. Gold depends on nothing except scarcity and the enduring human belief that scarcity has value. When counterparty risk explodes across the financial system, gold's most important property is that it has none. The mechanism behind gold's crisis behavior is simpler than most people realize. Think of it like this. Every time a central bank prints more money, every existing dollar becomes slightly less scarce. When dollars become less scarce, the things that are genuinely scarce become worth more in dollar terms. Gold is among the most scarce things on Earth. The total amount ever mined in human history would fill roughly 3.5 Olympic swimming pools. Nobody can print more. Nobody can manufacture it in a laboratory at scale. When the Federal Reserve injects trillions of dollars into the economy in response to a crisis, as it did in 2008 and in 2020, gold does not become more plentiful. The dollars chasing it do. That is the mechanism. It is not complicated. It is arithmetic applied to scarcity. In 1990, during the Gulf War, gold rallied as geopolitical anxiety spiked, and investors sought tangible assets outside the paper financial system. The same pattern appeared in every major inflationary period of the 1970s. Gold rose 400% between 1976 and 1980 alone, a period of dual oil shocks and record inflation. The asset has not changed its behavior across 5 decades of documented crises. What changes is the specific trigger: war, banking collapse, pandemic, oil shock, but the direction gold moves in response to each of them has been consistent. That consistency is the reason it belongs in any serious conversation about crisis-resistant assets. Now for Warren Buffett's relationship with gold, because it is nuanced in a way that is worth understanding rather than oversimplifying. He has publicly said multiple times that he prefers productive assets. A business that generates earnings, a farm that produces crops, a pipeline that collects fees. Gold, he says, just sits there. Over any 30-year horizon, he's almost certainly right. A diversified portfolio of productive businesses dramatically outperforms gold as a wealth-building mechanism. But in 2020, Berkshire Hathaway disclosed a position in Barrick Gold, one of the world's largest gold mining companies. Buffett bought gold during the most acute phase of monetary uncertainty in modern history. The message is not that gold is always the right answer. The message is that even someone who philosophically dislikes gold understands what it does during a specific window of crisis. A 5 to 10% portfolio allocation, treated as insurance rather than as a primary investment, that is the takeaway. If this framework is making the picture clearer, take a second to hit the like button on this video. It helps more people find this content when they are trying to make sense of what is happening to their money. The data on consumer staple stocks during the 2008 financial crisis is striking. The S&P 500 consumer staples sector declined approximately 15% during the crisis, compared to 57% for the broader S&P 500. In 2020, the consumer staples sector fell roughly 9% during the initial crash versus 34% for the overall market, and recovered faster. The gap is not small. We are talking about a difference of 30 to 40 percentage points of loss avoided during 2 of the 3 most severe financial crises of the modern era. That is not noise. That is a structural difference in how these companies behave when the financial system is under stress. The reason is something called pricing power, and it is worth understanding in plain language before we talk about which companies have it. Pricing power is the ability to raise prices without losing customers. Think of the difference between 2 businesses. One sells a branded product that people buy out of habit, preference, or necessity, Coca-Cola, say, or Tide detergent. When the cost of ingredients goes up, Coca-Cola raises its price by 10 cents, and almost nobody stops buying. The other business sells something interchangeable, a generic metal, a raw agricultural commodity, a piece of electronics that competes with 50 identical alternatives. When prices go up, customers switch immediately to the cheaper option. The first business has pricing power, the second business does not. During inflation and crisis, pricing power is the difference between a business that expands its margins and one that gets crushed by rising costs it cannot pass on. Here is a quick 3-question test for whether a business has real pricing power. First, would people keep buying even if the price went up 10 to 15%? If the answer is yes, pricing power is likely present. Second, Does the company sell something people need regularly, regardless of economic conditions? Food, medicine, insurance, utilities? Again, yes points to pricing power. Third, does the brand itself carry value beyond the product, meaning people choose it specifically, not just because it is the cheapest option available? Brand premium is one of the strongest indicators of pricing power. A business that passes all three questions tends to do what consumer staples companies do during crises: hold revenue, protect margins, and sometimes even grow while everything around them contracts. Buffett has organized the core of Berkshire Hathaway's equity portfolio almost entirely around pricing power. Coca-Cola, which Berkshire first bought in 1988 and has held for over 35 years, raises prices regularly and sells approximately 2 billion drinks every single day worldwide, regardless of economic conditions. American Express charges fees to cardholders who pay for the privilege of a brand, not just a payment mechanism. Apple, now Berkshire's largest equity position, operates in an ecosystem so sticky that its users are among the most brand-loyal customers of any consumer product in history. GEICO, which Berkshire owns outright, operates in the insurance market where people are legally required to carry coverage. Every core holding is a business where the customer keeps paying even when the economy gets difficult. That is not accidental. That is the philosophy made concrete. You do not need to own Berkshire stock to access this category. Exchange-traded funds that track the consumer staples sector broadly hold companies like Procter & Gamble, Johnson & Johnson, Coca-Cola, PepsiCo, and similar businesses with documented pricing power across multiple decades. These are not exciting investments. They are boring in the best possible way. They do what they are supposed to do consistently without requiring you to pick individual winners or losers inside the category. If you are ready to take what we are building here and apply it to your own financial position, there is something specific in the first pinned comment below this video. Built for people who are moving from understanding to action. In 2022, when Russia's invasion of Ukraine sent energy markets into a shock, the S&P 500 fell approximately 19% over the course of the year. The S&P 500 energy sector returned over 65% in the same 12 months, one of the largest divergences between a single sector and the broad market in modern financial history. While tech stocks, growth companies, and interest rate-sensitive assets were being punished by inflation and rising rates, energy companies were posting the highest profits they had seen in years. The same pattern appeared in 1990, when the Gulf War sent oil prices surging and energy company earnings followed. The sector does not just survive crises. During certain types of crises, specifically those involving energy supply disruption or inflation, it thrives. The reason energy behaves differently from other sectors during supply shock crises comes down to a simple truth about the modern economy. Energy is not optional. It is not a luxury that consumers trade down from when budgets get tight, like a restaurant meal or a vacation. It is the input cost of almost everything that exists in physical form: manufacturing, transportation, agriculture, heating, cooling, communication infrastructure. Demand for energy is what economists call inelastic, meaning it does not drop significantly even when prices rise, because the alternative to paying the higher price is not being able to function. When the supply of energy gets disrupted and prices rise, the companies that extract, process, and distribute that energy make more money per unit. Their revenue goes up not because they sold more, but because each unit they sell is worth more. That is a fundamentally different earnings dynamic than most businesses experience during a crisis. In 2008, when the financial sector was collapsing, the performance split between energy and banks was enormous. Financial companies, the ones that held mortgage-backed securities, the ones with excessive leverage, saw their stocks fall 70, 80, sometimes 90%. Energy companies with strong balance sheets and diversified operations held significantly better. Some of the integrated majors, companies with exploration, refining and distribution all under one roof, declined far less than the broader market and recovered faster. The reason is simple: their product kept being needed regardless of what was happening to bank balance sheets. Energy and banking crises follow completely different logic. The financial system froze. The need for fuel did not. Buffett's evolution on energy is worth understanding because it happened slowly and deliberately, which is typical of how he operates. For most of Berkshire's history, the energy exposure in the portfolio was relatively limited. Then beginning in earnest around 2020 and accelerating through 2022 and 2023, Berkshire built one of the most significant energy positions it has ever held. Chevron reaching roughly $19 to $20 billion, Occidental Petroleum growing to over 28% ownership of the entire company. He did not do this in a rush. He watched the sector, evaluated the businesses, and when his assessment of value versus price aligned, he moved decisively. The scale of the commitment, the largest energy position Berkshire has held in decades, reflects a considered view that energy infrastructure is structurally undervalued and will remain essential regardless of what happens in the broader economy or geopolitical landscape. Energy exposure does not require analyzing individual company balance sheets. Exchange-traded funds tracking the broad energy sector give you exposure to the category across multiple companies, reducing the company-specific risk. Midstream infrastructure, the pipelines and processing terminals that move energy regardless of its price, offers a slightly different exposure. These businesses earn fees based on volume, not price, making their earnings more stable across different oil price environments. Think of it as the difference between owning a gas station versus owning the highway the fuel trucks use to get there. Both are energy adjacent. The toll road operates with different economics. Understanding that distinction gives you options for how to construct your energy allocation. Before talking about how to access essential commodities, it is worth being precise about what qualifies as essential in the context of crisis investing versus what is speculative or fashionable. Essential commodities are the raw materials and agricultural products that feed people, grow crops, and build critical infrastructure. Wheat, corn, soybeans, fertilizer components like potassium and phosphate, water infrastructure, livestock. These are things where demand exists regardless of economic conditions because they address biological needs. Speculative commodities are different. They have demand that fluctuates with investor sentiment, industrial cycles, or technological trends. The distinction matters because during a genuine crisis, essential commodity prices often rise specifically because the crisis disrupts supply, droughts, conflicts, shipping disruptions, while demand stays flat or rises. The price signal runs in a completely different direction than discretionary goods. The historical evidence across inflationary crisis periods is consistent. During the 1970s, oil shocks, which were accompanied by agricultural supply disruptions, commodity indices broadly outperformed equities. During 2022, when the Ukraine conflict disrupted global wheat and fertilizer supply, while energy prices spiked simultaneously, commodity indices significantly outperformed the broader stock market. The S&P GSCI, a widely referenced commodity index, rose roughly 45% in 2022, while the S&P 500 fell 19%. That spread represents a dramatic difference in how essential commodity exposure behaved versus the general equity market during a supply disruption event. It is not that commodities always outperform, it is that during the specific type of crisis that involves supply disruption, they consistently have. Warren Buffett's most direct statement on essential commodities is not in a shareholder letter or an interview. It is in a transaction. Buffett owns farmland, specific parcels in Nebraska that he purchased and holds as a long-term asset. His reasoning, explained publicly, is that the farm produces something people need regardless of what happens in financial markets. The farm doesn't care about the Fed funds rate. It doesn't care about bond yield curves. It grows food. People eat food. The earnings of the farm, the crops it produces, are tied to something with permanent biological demand. He has described this as his preferred mental model for evaluating any investment. Would you rather own the farm that produces something essential, or would you rather own a piece of paper representing a promise about future earnings in an industry that might not exist in 10 years? The farmland wins for him. The principle, applied broadly, is a useful framework for thinking about commodity exposure. Accessing this category without owning farmland directly is entirely possible through diversified commodity ETFs, funds that track a basket of raw materials across energy, agriculture, and metals. These funds do not perform the same way as energy stocks or gold ETFs because the basket includes things that respond to different crisis types. An agricultural commodity spike from a drought moves them differently than an oil supply shock. That diversification inside the category is actually useful. You are not betting on a single commodity. You are holding a broad exposure to the category that tends to move when the specific thing that is most needed during supply disruption becomes scarce. Pay attention to this one because it is the most counterintuitive of the five. Most people think of cash as the absence of an investment, the money sitting on the sidelines, waiting, doing nothing. That framing is wrong in two ways. First, cash held in the right instruments is actively earning a return. During 2024 and into 2025, short-term U.S. Treasury bills, the instruments that Berkshire holds in enormous quantity, were paying between 4 and 5% annually. That is a real return above inflation, earned by the asset most people dismiss as not invested. Second, and more importantly, cash in a crisis is not a defensive asset. It is an offensive weapon. The financial crisis does not affect the person who holds cash the way it affects the person who holds only equity. The cash holder sees the crash as a buying opportunity. The all-in equity holder sees it as a disaster with no way out except waiting. As of late 2024, Berkshire Hathaway held over $325 billion in cash and short-term government securities. The media regularly asks Buffett why he is not deploying it. The question misunderstands the strategy. The cash is not waiting for the right investment. The cash is the strategy, a deliberate position that earns a real return while simultaneously giving Berkshire the ability to act decisively when prices reach levels that justify deployment. Buffett does not need to predict when the next crisis will hit. He just needs to be holding the cash when it does. At that point, the cash transforms from a conservative position into the most powerful tool available in the market. 2008 made this concrete in the most dramatic way possible. Lehman Brothers collapsed on September 15th. Within 2 weeks, Buffett had committed $5 billion to Goldman Sachs and $3 billion to General Electric, on terms that no other investor could have extracted because Buffett had the cash immediately available, and the counterparties needed it urgently. He received 10% preferred shares and warrants at below-market prices. The deal was extraordinary, not because Buffett was smarter than the market. It was extraordinary because he had the cash ready when the counterparties had no one else to call. $15 billion deployed in 2 weeks. The returns on those investments, measured over the following decade, were exceptional. and none of it would have been possible without the cash. Here is the version of the Buffett quote most people are missing. Be fearful when others are greedy, and greedy when others are fearful. Everyone knows that line, but almost nobody thinks about what it actually requires. Being greedy when others are fearful requires one thing above all others. You need cash. You cannot be greedy in a crashed market if you have nothing to buy with. The majority of investors who know that quote are fully invested at all times. 100% in stocks or funds, no cash reserve beyond a checking account, which means that when the fear arrives and prices drop, they can observe the opportunity from the sidelines but cannot act on it. They know the principle. They are not structured to execute it. Building and maintaining strategic cash is a skill that requires fighting the instinct to always be fully invested. The right structure for most people is somewhere between 10 and 20% of a portfolio in short-term, liquid, cash-equivalent instruments, high-yield savings accounts, treasury bills, money market funds, earning a real return while waiting for the occasion that justifies deployment. This is not a permanent parking lot for money you're afraid to invest. It is a deliberate reserve position, sized to give you the ability to act when others cannot, earning a respectable return while it waits. The 5 assets that survive crises become clearer when you look at them alongside what does not survive. Highly leveraged companies, businesses that have borrowed heavily relative to their assets or earnings, are the most reliably damaged category in any serious financial stress. Leverage amplifies outcomes in both directions. When things go well, it magnifies gains. When things go badly, it turns a manageable problem into an existential one. The 2008 crisis demonstrated this in the starkest possible terms. Lehman Brothers, Bear Stearns, and Washington Mutual were not poorly run businesses in normal times. They were excessively leveraged businesses in extraordinary times. When asset values declined, their equity was wiped out almost instantly because they had borrowed against those assets at ratios that left no margin for error. High leverage and financial crisis form a combination that consistently produces catastrophic outcomes. Long-duration bonds deserve special attention because they represent the crisis trap that most confuses traditional investors. For most of financial history, bonds were considered the safe haven, the place you put money when you wanted protection from stock market volatility. In 2022, long-duration treasury bonds lost over 30% of their value, the worst year for bonds in over 2 centuries. The reason is mechanical and worth understanding. When interest rates rise, the price of existing bonds falls inversely. A long-duration bond, one that pays you back over 20 or 30 years, is extremely sensitive to rate changes because you are locked into a fixed payment for a very long time. When inflation forces the Federal Reserve to raise rates aggressively, as happened in 2022, long-duration bonds get hammered. The safe asset becomes the damaging one, not because the principal changed, because most people holding those bonds had not thought through the specific conditions under which the principal fails. Let me address a misconception that costs investors significantly during crises. Many people believe that holding 30 individual stocks across different sectors constitutes crisis protection. It does not. What it does is reduce company-specific risk, the risk that any one business collapses for its own internal reasons. But during a systemic crisis, correlation between stocks rises dramatically. Assets that behave independently in normal times start moving together during a panic. In 2008, nearly everything in equity markets fell. Diversification across 30 tech stocks, 30 bank stocks, and 30 retail stocks all declined because the driver of the decline, a banking system collapse, affected the entire economic system simultaneously. Real crisis protection comes not from spreading across many companies in the same asset class, but from having exposure across structurally different asset classes that respond to crisis differently. Buffett's principle that brings the anti-list together is this: I'd rather have a wonderful company at a fair price than a fair company at a wonderful price. Applied to crisis preparation, this means that the quality of what you own matters more than how cheap it looked when you bought it. A leveraged company that was cheap is not a crisis-resistant asset. It is a crisis-vulnerable one that looked attractive during calm times. A consumer staples company with genuine pricing power, bought at a reasonable price, is a crisis-resistant asset that will still be standing and earning when the smoke clears. The question I hear most often when people encounter this framework is, do I need to own all 5 of these assets and in equal amounts? The answer is no to both. The 5 assets are not a checklist where you need a position in every single category to be properly protected. They are a menu of options, each of which addresses a specific type of crisis risk. Gold protects against monetary debasement and extreme fear. Pricing power companies protect against inflation eroding earnings. Energy provides crisis-specific upside in supply disruption scenarios. Essential commodities hedge against food and resource supply shocks. Strategic cash gives you optionality and the ability to act when others cannot. Understanding which risks are most relevant to your specific situation and which you already have coverage for is more important than mechanically buying all 5 in equal proportion. Almost every financial professional will tell you to invest every dollar you have working in the market as soon as possible, and there is genuine wisdom in that for long-term wealth building. But the person who has no strategic cash reserve is the person who, during a crisis, has no options. The right sequence for most people is this: strategic cash and a solid emergency fund first, fully funded before you think about anything else. Then from your investable portfolio, layer in the other 4 categories according to your timeline and risk tolerance. The emergency fund protects your daily life. The strategic cash reserve gives you the ability to act on opportunity. The other 4 assets build long-term crisis resilience. Skip the first step and the other 4 lose much of their power. Building crisis-resistant positions does not happen in a single transaction. It happens gradually, through a process of regular, disciplined allocation, what most people call dollar-cost averaging. The risk of trying to time your way into these positions, waiting for the right moment to buy gold or energy or consumer staples, is that by the time the crisis makes the case undeniable, the prices of these assets have already moved. The person who built the position gradually, in advance, owns the asset at blended cost below the crisis price. The person who waited for certainty pays full crisis premium price or misses the move entirely. Buffett has never tried to time the market. He positions himself before the opportunity fully materializes because he is buying value, not reacting to events. Here is what I want you to take from this video. Not the list of 5 assets specifically, but the underlying insight that makes the list meaningful. Every major financial crisis in the modern era, 1990, 2008, 2020, and the window that is building now, has been different in its trigger, its speed, and its specific damage. But the assets that held value across all of them share one property. They are either physically scarce, structurally necessary, or they carry financial optionality that becomes more valuable when everything else is failing. Once you understand that property, the thing these 5 have in common, you can look at any future crisis, whatever its cause, and already know the rough direction of where capital will move. That knowledge is not a guarantee of anything. It is a framework. And a framework turns an overwhelming news cycle into a navigable landscape. Buffett has said something that sits at the core of this entire video. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. The word simply is doing a lot of work in that sentence. There is nothing simple about being calm and deliberate when the financial world is in chaos around you. But it is possible, and it is primarily possible for people who have done the preparation work before the chaos arrives. The positions are already built. The cash is already there. The assets are already held. When the crisis hits, the prepared investor does not scramble. They execute a plan that was already in place. That is the real advantage, not prediction, preparation. You now know what the 5 assets are. You know why they work across different types of crises. You know what Buffett has done with each of them, and why. What you do with this information is yours to decide. But the pattern has shown up 4 times in 35 years, clearly enough that anyone who looks directly at the data can see it. Crises are, by definition, unpredictable in their timing. The assets that survive them are not. Stay curious, stay informed. Write in the comments if this landed with you. I position, I don't predict. There is another video ready on screen right now. Keep building the picture. Thank you for watching. We will see you in the next one.